Everyone's panicking about the AI bubble popping, or tensions with China, or whatever the latest political drama is in the Oval Office. But the absolute biggest risk to the US economy right now? It's none of those things. It's actually incredibly boring, it's hiding right in plain sight, and traditional financial media is completely missing the boat on it.
Look, I get it. Those flashy topics get all the clicks, right? They completely dominate the headlines because we all love a loud, dramatic narrative. But here's the thing about markets. The real threats, they're rarely the loud ones. The loud stuff is usually already priced in. The actual threat we need to unpack today takes a little bit of nuance, and it's the exact reason why things feel so off in the economy right now, despite what those flashy headlines are telling you. Seriously, think about it. Have you been wondering why mortgage rates just absolutely refuse to come down? Or why the stock market randomly throws a tantrum every few months? Or how the Fed can be out there openly talking about cutting rates, but money still feels incredibly tight? Well, the answer to that whole mystery doesn't actually start in Washington. No, it starts in Tokyo.
Which brings us to Chapter 1, the real economic threat.
Okay, so we really need to talk about what is arguably the most boring asset on planet Earth, which, ironically, just so happens to be the secret gear turning the entire global financial machine. I'm talking about Japanese government bonds. See, Japan has quietly been acting as the financial duct tape holding the whole global system together for the past 30 years. But here is the absolute critical warning for this explainer. That 30-year-old duct tape? Yeah, it's finally starting to peel off. And to understand why Japan has this insane amount of unseen power, we gotta look at how they even got here in the first place.
Let's roll into Chapter 2, Japan's Lost Decades.
To really grasp today's mess, we actually have to hit rewind all the way back to 1992. Over 30 years ago, Japan had this massive historical asset bubble, and it burst. Real estate collapsed, equities totally tanked, and they entered this grueling 3-decade stretch that economists call the lost decades. We're talking zero real growth, zero inflation, no wage expansion. The economy basically just hit a giant pause button. So what did the Bank of Japan do? Well, they did the only thing central banks can do when they're totally out of ammo. They slashed interest rates all the way down to zero. And when that wasn't enough, they literally went below zero. And crazily enough, when even negative rates didn't work, they introduced a little something called yield curve control. Now I know, yield curve control sounds like some sort of Marvel supervillain, but in reality it just meant the Japanese government stepped in to forcibly cap their long-term bond yields. So instead of letting the free market do its thing and decide the price, the government essentially superglued interest rates to the floor. For decades, domestic government bonds in Japan yielded absolutely positively nothing.
And that sets the stage perfectly for Chapter 3, the yen carry trade.
So the really crucial point here is what happens next. Put yourself in their shoes. Imagine you're a Japanese pension fund or a massive bank sitting on $1 billion, and your domestic bonds are paying you exactly 0%. Naturally, you want a return greater than zero, right? Well, meet Bob. Bob is our proxy for those Japanese investors today. Because Japan effectively turned into the world's ATM, Bob is about to pull off one of the greatest, most lucrative financial maneuvers in history.
This maneuver is famous. It's called the yen carry trade. Let's look at the actual mechanics of how this works. First, Bob borrows money in yen at those near-zero interest rates we just talked about. Then, he takes that borrowed yen, converts it into US dollars, and uses those dollars to buy US treasuries that are yielding, say, 4%. After he covers some basic currency hedging costs and a few fees, Bob just pockets the spread. Boom! He is literally exploiting the math to print free money.
But here's the kicker. Bob wasn't just buying safe treasuries. When borrowing costs are basically zero, investors start buying anything with a pulse. They bought tech stocks, they bought commercial real estate, they poured money into emerging markets. This single trade evolved into a massive trillion-dollar source of global liquidity. Honestly, it was like the entire global financial market was running on Japanese Wi-Fi. Everything, everywhere was connected to and powered by this endless, invisible stream of cheap Japanese capital.
Which brings us right up to the present in Chapter 4, when the math flips.
Fast forward to 2024, and let's see how this all builds into an absolute disaster. See, this entire trillion-dollar global system, it relied on one singular assumption: the Japanese yields would stay at zero forever. Well, in 2024, that assumption totally broke. The Bank of Japan officially pulled the plug on yield curve control. They hiked interest rates for the first time in 17 years. And then, they hiked them again, and you saw the market reaction. It was violent, and it was immediate. The S&P 500 instantly dropped 6%, and Japan's Nikkei index, it plummeted over 12% in a single day. That was its worst drop since Black Monday in 1987. Markets were officially spooked. Now, why all the sudden panic? Simple, because the math flipped. Under the old math, we had free money and super cheap hedging. It was great. But under the new math, those rising Japanese yields mean borrowing in yen is suddenly way more expensive. And hedging against currency risk? That's gotten super expensive too. All of a sudden, Bob's 4% US Treasury doesn't look like such a genius move anymore. The free money trade was officially dead.
And that exact dynamic brings us to a really important concept, repatriation. Because when the math flips, the capital flows flip right along with it. All that money, those trillions that flowed out of Japan for decades to prop up global markets, is finally starting to return home. Guys, this is without a doubt one of the biggest, most silent threats in global markets today. The cheapest source of global liquidity for the last 30 years is officially no longer cheap.
To really understand the gravity of what this means, just listen to this quote from Ray Dalio, the founder of the world's largest hedge fund. He says, quote, "The bond market is the basis, the backbone of all markets, and he is spot on. It determines what all asset returns are going to be. When you get a massive supply and demand imbalance in bonds, interest rates are forced to rise, and that puts the Federal Reserve and really every other central bank out there in a massive, massive bind."
Let's talk about what that looks like in Chapter 5, the global ripple effect. So let's connect all of this directly back to you. Why does an invisible gear breaking in a Tokyo bank actually hit your wallet on Main Street? Well, it's because everyone out there hyper-analyzing Federal Reserve Chairman Jerome Powell is honestly staring at the wrong lever. The Fed only really controls short-term rates, right? Like the overnight rate. But the long end of the yield curve, the 10-year, the 20-year, the 30-year yields, those are driven entirely by global supply and demand. And for decades, Japan was the reliable, price-insensitive buyer who gladly absorbed America's trillion-dollar deficits. So just notice the domino effect that happens here. If Japan suddenly stops buying, yields naturally have to rise to attract new buyers. This creates what we call a steepening yield curve. And when long-term rates stay elevated like that, the mathematical models that analysts use to value stocks literally start to break down. The present value of future cash flows drops, which means stock multiples get compressed. Think about that for a second. Even if a company's earnings are perfectly fine and they're doing great, their stock price can completely plummet simply because the underlying cost of capital changed.
But here is the real impact on Main Street. The 10-year Treasury yield is the foundation of nearly every single asset valuation out there, especially your housing market. So if global demand for our debt starts weakening and long-term yields stay pinned high, mortgage rates are not going to magically drift back down to 3%, no matter how many times the Fed cuts those short-term rates. Housing stays completely unaffordable. Corporate borrowing stays really expensive. Companies stop hiring. Business growth slows down, and capital just tightens up absolutely everywhere.
So I'm going to leave you with this final, somewhat provocative question to think about. We are constantly sold this narrative that one Fed rate cut fixes absolutely everything and that someone somewhere will always magically show up to buy America's debt. But if Japan, literally the largest foreign holder of US Treasuries and the main engine of global liquidity for 30 years, if they decide to take a step back, who buys our debt? When global liquidity tightens, the cost of money changes everywhere for everyone. And my friends, that is the real economic threat hiding right in plain sight.